much for coming to, I think, what is our penultimate autumn seminar. I think we've got one in early December on the budget changes, which obviously we don't know what they are yet, but we'll see what we've got in store for those. We are now covering today something that happened in the previous budget, so everything's keeping us busy in the budgets. I'm very pleased to introduce James Baxter, one of the founding members of Tideway Wealth Management, who's come up from London to talk to us about his experience of pensions and the changes that have happened in October 2024, or will be happening, sorry, in April 2027. I'll be jibbing in and out with some tax technical bits, but the floor really is James's today, so thank you very much for coming over.
That's a pleasure. Well, welcome everybody. You'll be pleased to know that pensions are the same in London as they are in Manchester, so it doesn't make any difference where we are. We're wealth managers, and we have probably 350 million in pension assets out of sort of a total of about 500 million. So pensions and inheritance tax is obviously pretty high up on our clients' minds. So we're going to have a little kind of recap, just look at why we bother with pensions in the first instance, a bit of history about the rules around pensions and what happens on death and how we got to where we are today with the changes, some mitigation strategies, some case studies. I'm not going to go through the introduction to Tideway Wealth, you can read that yourself, so don't worry, I'm not going to spend 10 minutes on that. I'm very happy to take questions as we go along. Laura's got some technical bits in here, and number 3, and I think you're going to run through those and then take questions at the end. But as far as I'm concerned, the more interaction we have and the more questions from the floor, the more fun we'll have, I think. Yeah, it can be fun. So this is just a quick reminder. Hopefully most of you are reasonably familiar with pensions. Why do we bother with them? Well, we get tax relief on contributions, we get a tax-exempt fund, and when you combine those two things together over a long period of saving, you get a massive uplift from saving into a pension and just saving into a taxed account with any relief on the premiums. So just a little example, if you're saving £6,000 a year and you're a 40% IRA taxpayer and you do an exercise for 20, 30 years, you end up with 700,000 in your pension versus 300,000. So you've got a double amount of capital, and that's all coming from the tax relief. Same return, but it's just the tax relief building up over the years. You're only paying 60p in pounds to put your money in, and then you're not paying tax on income. You pay some tax on dividends now, but not very much. So it's the exempt roller. We reckon that having an exempt fund is, depending on the return, is worth somewhere around 10 to 15% every 5 years, just by having it in a gross fund rather than one that's taxed. So you're just going to get a bigger return for the same amount of risk and the same return. We still have a tax-free lump sum. It's now fixed at 268,275, and we still have tax-free funds before 75. I got told off by one gentleman in the rooms for being very pessimistic, but people do die before age 75. It's still, we've still got that sniper's alley, as they call it, where if you get a heart attack and we've had 21 of our clients die already before 75, and some of them actually died, unfortunately, before reaching retirement age. But in that scenario, the fund is still payable to the spouse, fully tax-free. So it's like having a really nice insurance policy. As you get older, there's more in it. If you happen to, catch one of those bad diseases and die, then your family is protected. But if you don't, then it's a good insurance policy because you get to spend it afterwards anyway. So it's kind of a win-win situation. So that's why we bother with it. We've got a lot of accounts, over 1 million. It depends, it's quite hard to save just straight out of earnings to get to over 1 million these days. But if you start young, there was a little piece in the FT we did it last weekend. Moira wrote about with people gifting down the generations. So if, for example, I think the example we did was putting 180,000 in. So if you could get, the maximum amount you can pay in is 60,000. So if you could do that for 3 years, if you're fortunate enough to inherit some money, and you were able to leave that for 30 years, that would be 580,000 in today's money at the end of the period. So, you know, for what I think we're going to see with the sort of trickle down of wealth, we're going to see people in their 30s inheriting, you know, little chunks of money here and there. And so actually putting that money in quite early doors and allowing it to compound up is a really nice way of boosting your pension. I thought I'd talk a little bit about the history, because a lot of people have said to me, oh, will this inheritance tax on pensions, will they reverse it, or will a future government reverse it? And I always use the example, when you drive out through Kent down towards Dover, you see that the farmers have got these containers parked over the motorway which says, you know, ban inheritance tax on farms. There's been a political uproar on that. There hasn't been that much, you know, you don't see people protesting in the streets about inheritance tax on pensions. It is actually politically one of the things that they've been able to get through reasonably without too much protest. My view is it's here to stay, and this is just really a reminder that we didn't, you know, when I first started advising, I actually started somewhere just before that, there really was no value on pensions at all. What you used to buy was a deferred annuity, so you paid some premiums to Scottish Widows or Standard Life, and they gave you an income if you got there, but along the way it was worthless, and if you died it was worthless. So it really was just a kind of insurance policy and an annuity payout. 1995 to 2011, that was in 1995 was the introduction of income drawdown. It looked slightly different then. There were limits. You could only withdraw up to the maximum of a percentage of the annuity rate, and you had to draw a minimum. And when you got to 75, you had to buy an annuity. So it was really a kind of flexible way to access your fund for a period of time, but you still ended up having to buy the annuity. The requirement for a compulsory annuity purchase at 75 actually went in 2011. Anybody know why it went? It was Cherry Blair who pushed it through, and it was done for religious reasons, because some religions find it abhorrent to basically have a return that's based on somebody else's death. And so she managed to change the law so that there was no compulsory purchase. So then suddenly drawdown became a lot more interesting, because you could carry on without, you know, annuities by this stage. 2015 were deeply unpopular. People really didn't like them. And so I think the last annuity I actually sold was about 2006. And most of our clients who were younger then than they are now were all in this sort of drawdown, wondering what was going to happen. And then we got this good news that we didn't have to buy the annuity. So in fact, when we had pensions freedom in 2015, most of the freedoms were already in place. But what had been in place up until that point was a 55% charge on death. And now that's been changed to have this inheritance tax charge on death. So it's slightly now means tested. So not everybody's going to pay it, whereas the previous 55 was a flat rate, everybody paid it. So now it's got a bit of means testing about it. And also the 55% was charged and then you got cash. Whereas now what happens is you pay the inheritance tax and then you pass the pension account with its exempt rules for investing onto the next generation. So it's slightly different. And we've ended up here with this rather nasty scenario that if you pass it on to somebody who's a higher rate taxpayer, you could end up paying inheritance tax of 40%, and then that person trying to withdraw their pension could end up paying income tax of 40%, so you get into some combined tax rates of 60%. So this is really, you know, we've been through a phase where a lot of people were not drawing from their pensions. A lot of our clients weren't ever drawing on them. They saw them as being intragenerational accounts. It'd be great to leave this to our children because they're never going to be able to build up these pensions. And now, you know, the government's made a very clear statement, which is to say your pension is basically for income in retirement and you need to use it for that, because if you don't, you're going to tax it pretty heavily. So it's quite a big shift. we've had a lot of people talking about it. We haven't had a lot of action yet in terms of people changing the way they're withdrawing. We fully expect that we'll get people drawing more out of their pensions. We're going to look at that in a minute. But so far, obviously, the rules don't come in until 2027, and it's it's something that people are thinking about, but not actually doing very much on at the moment.
As it stands at the moment, if a person dies and leaves 4 children, do the 4 children, let's say it's equal, they get 4 equal pension pots?
So, thank you for asking the question, because it's a good one to ask. So a pension in the UK is a trust. So there's a young man here with a trust qualification at the front who's a lawyer. But yeah, I don't know whether you knew that. Did you know that?
It didn't come up on the exam.
It didn't come up on the exam.
If you say so.
So the way, different pensions in different countries are structured in different ways. But in the UK, our pensions are structured as trusts. And if you go to AJ Bell, who we use, or Hargreaves Lansdowne, or any one of these, you get a sub-trust. So it doesn't, when you have it, it doesn't feel like a trust. You're not having to have trustee meetings or sign documents or anything. It's all been percolated down to a very simple account. But nevertheless, that is not your money when it's in the pension fund. It's held by the pension trustees on your behalf as a beneficiary. And what you do with a pension account is you sign, or you should do, is sign an expression of wish, which means that when you die, you will have left some instructions to the trustees as to what to do with the money. So if you had 4 children and you died, and it was after you were over 75 on the death, you would leave 4 separate pension accounts to those 4 individual children, assuming you didn't want to leave it to a spouse. And they would then have to, there wouldn't be any more tax-free cash for them, but they would have to pay income tax to withdraw the money from those accounts. Does that make sense?
Yeah. So
Yes.
it's always passed on as a pension, not as cash.
They have the choice to cash it, but if they cash it, they're going to pay income tax to do that. Yeah. But yes, it is. If you die before 75, it's a tax-free payout. So then you don't have to pay income tax on it. And actually, what happens when we've got 21 of them, it's very attractive for whoever's left behind. I mean, they literally effectively turn your account into blooming great big ISA. So the rules then look just like an ISA account. No tax, no income tax, no capital gains, and draw out when you like, what you like.
But it's still a pension.
But it's still a pension account. It's SIP, but it's marked as a pension that's been taken from somebody who's died before 75. So we've still got this quite big changeover at 75 from sort of that exempt or tax-free payout to now inheritance. Well, now at the moment it's just income tax, but from 2027 it's going to be inheritance tax and then income tax. So the difference in that case at the moment, if they died, they get the 4 pension pots split out, and that would be that. Post April 2027, those accounts will have to go on the IHT 400 form, and there'll have to be a tax payable on them if overall you're subject to inheritance tax. So they get added into the estate and then the tax payable. You had a question?
I think you've answered my question. It was basically when the beneficiaries, if they want to access the pension fund, regardless of their age, they can access it. It would just be the difference is the age of a person that died as to whether there is.
Yes, so whether it could be left to a minor, so it could be under the age of 18 and they can still take the money out. And obviously we're going to look at that as a potential mitigation strategy because they probably aren't paying any tax to withdraw it. But yes, it's quite interesting because although these rules have been in place for quite a long time, not many people have died, so there's not many inherited pension accounts out there. I mean, I don't think we've got one yet. Most of the people that have died for us have all been under 75, so they've ended up as these widows or spouses accounts.
Just a quick question.
Yes.
Post 27,
Yes.
you've got an inheritance tax liability.
Yes.
Can the pension fund pay that, or would it have to pay income tax?
I'll cover that in the next few
All right,
slides.
okay.
Thank goodness for Laura. So, Laura's going to cover and that's the bit that they have been changing. There was because they came out and consulted on it originally, and people were thinking, oh, maybe it's not going to happen. It did happen, but they have changed things, which Laura will run through as to how it works. Is that all clear? We're clear on pensions, we're clear on the death benefits, and you can see from that chart, you know, my feeling is that this was too generous, this period here, really, and we're probably now in, you know, a more stable scenario. So whether it's a Conservative government, a Reform government, dare I say it, or any other government in the future, I have a feeling that they're not going backwards on this, because it's quite a big tax take. Laura.
Yeah, just so to cover the inheritance tax position of the pensions. As James mentioned, they are trusts and they're discretionary trusts effectively, so that's why you give a nomination, isn't it? And you don't say it should benefit this person, because if you did that, they would always be taxable to inheritance tax. It's the discretionary element now that's becoming taxable. So things like death benefits on pensions. So that's like registered pension schemes are called, section 6153 schemes. I'm not going to use technically what these are, but when you come across them, you will know what they are. But just think about registered pension schemes. What we found is we have a couple of clients whose schemes aren't caught, which is quite fortunate for them. We've done some analysis on that. Not yet, anyway. And they are what we call the pre-A Day funds, which is before 5th of April 2006. And they're like unapproved superannuation schemes. And they're often offshore, a lot of these things have been exported. And final salary not caught either. So your everyday SIPs and things like that, and the SASs generally are caught.
So those are herbs, is that right?
Yes, herbs.
Herbs.
Yeah, before herbs, off herbs. Yeah. So very, very few of these, but there are a few. So don't automatically assume you will be caught. You might need some analysis to find out whether you are or not. And what that means is the value of the pension fund falls into the estate. As so, you would obviously, when somebody dies, you assess their free estate, which is all assets they own on death, and you aggregate with that now the value of the pension fund as well. And what happens, how you calculate the inheritance tax due, is very much like if you had what's called an old style trust, an interest in possession trust. You'd have your free estate, your trust that they can benefit from, and your pension. And you would say, okay, let's add them all together and let's get the nil rate band allowance and let's apportion it out on a pro rata basis against all those funds that you've got. So in a typical example, somebody will die just owning their house, maybe a rental property and a pension, and you just add together all those values, and then 325,000 nil rate band, if it was available, hadn't been used in lifetime, would be pro rata against that to give some relief to the pension fund and some relief to the free estate. So they're saying a lot of these pension funds will not be subject to inheritance tax because the aggregate of the value of the estate won't be more than 325,000, or perhaps 650,000 if you have had a spouse who's died before you and not used their nil rate band allowance. What it's going to do though is put a lot more pressure on personal representatives and pension scheme administrators, because obviously it's a completely new system. We've not gone through it yet, so we don't know what the practical problems are going to be, but we can see already there are going to be some problems. The personal representatives are very familiar with doing the reporting for death estates. They are responsible for doing the IHT 400 in the more complicated cases. They will have to liaise with the pension scheme administrators to find out the value of that pension fund so they can work out how much nil rate band allowance they have. Some of them are quite nervous about, I don't know if you know, but a lot of people have lots of little pensions in here and there and everywhere and often don't know how many they've got. So they're quite nervous about submitting a form saying, yes, this is the value of the estate with the pension, and we know the nil rate band is going to be aggregated in this way. They're quite nervous about that because there might be some other pension that comes into fruition they find out about in 2 years' time or something. Now, there are time limits the pension scheme administrators have to come back to the personal representatives with, quite a short period of time. Payment of the tax. Now, originally, as James alluded to, there was a consultation document, and originally it was quite sensibly, I thought at the time, and said, well, the pension should pay its own tax and the free estate should pay its own portion of the tax. However, the people who work in this industry said that's not going to work because, number one, pension scheme administrators are not used to dealing with this, and also it's just simpler if the PRs, the personal representatives, pay all the inheritance tax up front. Now that's easier said than done, you know, you've got to have liquid assets to physically pay all the tax that's due on the pension and on the estate. but that's the way that most people will look to do it. So you pay it all from the estate, and then if the beneficiaries are the same of the pension and the estate, all well and good, you can simply pay out the pension then to the beneficiary. If they are different, let's say we've got a spouse receiving the free estate and another individual, the son for example, receiving the pension, they're not the same people. And therefore, what the PRs have, they have the ability to go to the beneficiary of the pension and statutorily claim back the inheritance tax that's been paid on that pension fund. So they're going to have to claim it back from the beneficiary. Alternatively, the beneficiary can direct that the pension fund pays its own way in terms of inheritance tax. But at that time, you need to know who the beneficiaries are. And if there's only nominations, it's not necessarily decided who that beneficiary is going to be, which might cause delays, cause interest to accrue on the inheritance tax payment. And obviously with the interest rates being really high on underpaid tax, that's not really an option for most. If you're talking about the free estate paying it all, then yes, they have to have liquid cash to do that, or they might have to sell some investments to do that. They can't do that until they get probate. They can't actually access those assets until they get probate. So you might have to go for things like the direct payment scheme, using the deceased bank account, paying the inheritance tax that way, or the instalments option, which is available for certain assets in the estate. So it's going to be quite tricky, and obviously we haven't done it in practice yet, so we don't know how it's going to work. Yeah.
When you said the beneficiaries pay the inheritance tax, do you mean the beneficiaries or do you mean the actual pensions?
Well, they can direct the pension pays it, or they
So
actually,
they don't have
or
to pay tax on getting that money out to pay the IHT.
yeah, basically saying that they can pay out the pension to the beneficiary, because what they don't want to do is cause hardship for the pension beneficiaries.
Yeah.
So they can pay the pension out to beneficiaries and they can claim back the tax from the beneficiary, or the beneficiary can say to the trustees, please pay the tax. There's two options there, or the estate pays it all. Now, of course, you might ask a question when you come to know how the system works, is that when you pay the inheritance tax out of the pension, clearly you're depleting the value of that pension, and there's less left in it, which will then be subject potentially to inherit income tax if you're aged over 75 when they die. So what you don't want to happen is if the estate pays all the tax, leaving the pension fund bigger, in reality it should have had to pay some inheritance tax. Yeah. So what they allow you to do is the beneficiary would say, well actually I've taken out more from this pension than I should have done because it should have paid inheritance tax, and I am paying income tax on that withdrawal from the pension fund. So they then have to go to HMRC and claim a repayment of that income tax for the element of the inheritance tax part. Does that make sense?
Yeah.
So again,
Sounds like an absolute nightmare.
yeah, it's really, really simple, because obviously it's really easy to get money back from the revenue. It's really quick and simple to get money back from the revenue. So it's going to be difficult.
For your average PR, that's going to be a total nightmare. Never mind if you're dealing with an advisor that has no.
Yeah, absolutely. And it's going to be a nightmare for the beneficiaries. Well, the beneficiaries going through a grieving process. They're going to start reclaiming.
Well, I'm not suggesting, I'm suggesting those in this room.
They have got very strict time limits that they have to respond to the PRs by. It's really quite quick that they have to get that information back to the PRs so they can't run
But in simple terms,
Yeah.
if the sort of pension pays the inheritance tax,
Yes.
is it taxed at the personal rate of the beneficiary? If he's a 40% taxpayer,
So no,
he'll
if
have to
the
pay two lots of
pension
40%.
pays its inheritance tax, that's gone from the pension. There's no income tax on that element. It's whatever's left there's income tax on.
Yeah. So you can take the inheritance tax out of the without any tax at all, without any income
Yes.
tax.
Yeah.
Yeah, it's a liability of the pension.
It'd
There's
be a
no
bit bad
liability.
if you
So really, you're best taking it out of the pension, aren't you?
It's a simpler way.
You
It's a
can't take it all out, you don't have the flexibility.
No, the
do you?
pension can't pay any more than its liability on its own assets.
Yeah.
You can only direct it to pay its share of the inheritance tax. Can't pay any more than that. And obviously if it pays too much, you have to have a refund back into the pension fund as well.
A few people thought when they had that consultation that they were actually saying you only pay inheritance tax and not income tax as well, but they weren't. They were saying you're not going to have to pay inheritance tax and then income tax on the inheritance tax if you've paid the inheritance tax from somewhere else. So,
So the default method is that the beneficiaries pay the IHT.
No, the default measure is the personal representatives pay it. That's the kind of what they announce. That's what all the professional people said is like it's better if the PRs pay it, and then they claim it back off the beneficiary afterwards.
Okay, but the beneficiary is not paying income tax on
that element.
the element of the Irish Harvest.
Yeah, which is what you would
Well,
expect,
they would
isn't
to
it?
begin with, because you just said they'd do.
They would to begin with, and then they have to make a repayment claim to HMRC. So it's against them to start off with. It's not automated yet.
Presumably, when you say they would to begin with, it would be because through a PAYE mechanism, would it? Because when the pension.
Probably, I would have thought so. When you take a withdrawal out of a pension,
Yeah.
I would have thought so. I'm not sure how quickly that gets put in place when you're taken out following someone's death. You have to James answer this question. When somebody dies and then you say, okay, the nominated beneficiaries are the 2 children, we're going to pay it to the 2 children. Is it automatic for you then to get that pay as you earn?
Honestly, we've not been through that yet.
Right, okay.
I mean, all the ones that we've dealt with have been to spouses, and so they've been just turned into tax-free accounts.
Okay. Yeah, I don't know the answer.
And then there's no PAYE after that. They just
Yeah,
become
because the dad was
ordinary
75.
withdrawals,
Yeah. So, any more questions on the practical? Yeah.
You don't suppose that HMRC might extend the deadline for the payment of IHT? Because I mean,
Well, they've talked about that. They actually put that in the consultation. People said 12 months, 2 years, because that's the normal period that you have to decide who the nominated beneficiaries are, etc., or to actually allocate the pension. And they said no to that. So,
So we're stuck with the same.
yeah. And the high rates of interest.
Yeah, 8%, I think.
Yeah, it's really high. Pass over back to you, James, I think.
So we've got a few.
Sorry.
We've got our names on them. We've got a few strategies here as to what you might do now. We've got these rules imminent. It looks like they're going to be here to last. So we shouldn't just put our heads in the sand and carry on as if nothing's happened. We should actually think about it and make some choices. Broadly speaking, Laura and I came up with these 6 opportunities. Spending the account before you die, that's probably the most obvious thing to do. We've still got the spouses to think about. Charitable donations, Laura I think is going to cover these 2 bits. There is some case for actually paying the inheritance tax and then leaving accounts to the next generation, but we're going to look at that and think about the issues there. Life assurance is obviously, the advisors are all getting hot under the collar about life assurance, and I think we're hearing anecdotally that more policies are being sold. And then there's the whole issue of going abroad, which I think Forbes Dawson are fully into. So, use it, don't lose it. That was I coined that phrase. Thank you. And if you go onto the internet and you Google pensions and withdrawal rates and things like that, you'll come up with things like the 4% rule. So the 4% rule is basically some American actuary did some maths and worked out that if you draw at 4% and you get an average return from a sort of managed fund, you shouldn't run out of money during your lifetime. So that's been the sort of way the industry has looked at withdrawals in income drawdown. Sub 4% would be considered a relatively low withdrawal rate. Above 4%, there would be some risk of running out of money before you reach death. Now, obviously, if we want to run out of money, we've done a whole load of maths. There's some bits on our website if you want to go and look at the different ages. But basically, if you want to try and get through the account in 20 years, if you're making 6% per annum in the fund, and given that we have returns on gilts now of around 4.5% to 5% for longer duration gilts, that 6% is not a crazy, that's relatively conservative return rate now. You would need to draw at 8.8% per annum in order to get the money out. So that's a much bigger withdrawal rate than people have been talking about. So if you've got £1 million in your pension account at 60 and you want to get through it by the time you're 80, you're looking at taking £88,000 a year out as a regular withdrawal. There's this frowning face over there. Does that sound too high to you? What are you frowning about? No? Put you on the spot. I mean, we've been having lots of conversations with people about these rates, but we haven't really got a lot of buy into it yet. But I think that it's going to come, and that's going to be the way to do it. you know, what we've seen is that pensions were considered, you know, the very last thing that you would touch. So you would spend your ISA money and you'd spend your other money, maybe you do equity release, but you keep the pensions to pass them on because it's all quite attractive. Now we're seeing that go the other way around, and it's kind of the first thing that you want to get through. So that means you're going to need some sort of plan for financial security beyond when you plan to run the account down. So if you plan to run the account down by the time you're 80, then you know then you're going to need some other form of financial security to get you through however much longer you might last. I actually think that's quite a good thing. We talk quite a lot about 20-year plans because a lot of our clients are in their late 50s, early 60s, and a 20-year plan gets you into your early 80s. And what we do notice anecdotally with our clients' parents is that spending tends to go down after 80. It varies from some people to others. I mean, what's the Formula One guy? He's managed to carry on spending well into his 80s. But most people will get to a point where they start, you know, they're not taking holidays as much, they're not renting cars, they're not doing as much. So their spending goes down. So actually breaking up your retirement planning into a sort of 20-year high income active period and then a second phase of what you might need. And also obviously the more important things might be care and medical needs in the last bit, and they tend to be lumpy rather than month by month income requirements. So having access to ISAs are going to be the key account to hold for later life. They're perfect because if you need a hip replacement or whatever, you can go straight into your ISA account and take it out without worrying about income tax. There's some fancy things we can do around the withdrawals. I mean, we're all conscious of the death zone in tax rates where you go over 100,000. So you end up losing your nil rate band. You end up with an effective 60% tax rate between 100,000 and twice the nil rate band, which is pretty ugly. So the way, you know, one strategy to do that would be rather than having a withdrawal, if it turned out that your withdrawal, let's say, was £115,000 a year, you wouldn't draw £115,000 a year. You'd draw £90,000 plus the state pension to get you to 100, or 85,000 plus the state pension and other income. And then every once in a while, you would take a big withdrawal and go straight through the, you know, the horrible bit and maybe take 200,000 out of the account. But it's all going to be about, you know, trying to track this account down to zero, probably by your mid-80s. Any questions on that?
And you, as you said there, you're not necessarily going to spend it all, are you? So you might want to give it away.
Yes. So yeah, I mean that's a good point, Laura. So two things that you can do if you need more of this, because most of your savings are in your pension and you don't have these things. You could use excess income coming out of the pension to start saving into ISAs and build up the ISA accounts for later life. So in effect, you're using the same account for a whole of life retirement, but you're just shifting it from your SIP account or your pension account into your ISA account over time. And then we have the gifts out of income for the time being. So we'll wait and see whether those get the tax in November. But at the moment, we have the ability to make gifts out of surplus income. And the good thing with, if you've got high pension withdrawals, is the revenue can't argue that it's income because they want to tax it as income. So it's very clearly income. And you can make gifts out of those which are immediately outside the estate for inheritance tax. So it's a great way to pass money on a regular basis to the next generation. That's surplus income. What makes no sense at all is to just do it and then hold on to it in your personal estate, because if you do that, then you've shifted 40% tax on your pension to 40% tax on your savings. So you need to bring the money out of the pension and get rid of it somehow. Or at least only self-fund what you need for the last bit. One thing that we spend a lot of time talking about, if you're going to withdraw at 8.8% per annum, you're going to have to really think carefully about how your account is invested. So we have if you invest in stocks and shares, which has been the traditional methodology of investing pension funds, what I call volatile investments, investments where the price goes up and down, or goes down as well as up. When you're saving money, a volatile market helps you, because as the market goes down, you actually end up buying more shares at the lower price, and then when it recovers. So actually saving into a market that's flipping around, you end up with a bigger return if you invest monthly into it than if you just put a lump sum in and wait to the end. It's called pound cost averaging, and you can go on the internet and there's 54 different people who'll explain it to you. The same thing works in reverse when you try and take money out of a volatile investment, which is that if you can imagine, let's say you've got £1 million and you want to take 100,000 out, you're taking out 10% of the fund. If the million goes to 800,000 and you still want to take out 100,000, you're now taking out 12% or 13%. So you end up depleting the account very rapidly, because you'll be selling more units when the price is low and not benefiting from the recovery because you'll have less in your account. So the emphasis if you're going to do this sort of approach is to have a nice smooth return, which generally means investing in fixed income rather than necessarily investing in equities. And there's also one of the things we do, which is catching on a bit now, is we have a dual account. So if you're going to have some, because even this might be a 20-year period, so you might want to have some equities in there, but you separate them out into a separate account, and then you have some fixed income that you're going to then withdraw from each year, and these ones aren't touched. So if you're using an insurance company where it's all in one managed unitized fund, every time you go to the well and take a withdrawal, they're going to cash some equities, some fixed income, and some whatever else there is in the fund. But you don't want that. You want to be able to say, no, I want fixed income to cash for my withdrawals, and I want these equities to last for the long term. So it's putting a premium on how the money's invested if you're going to have higher withdrawals, basically, which is good news for us because people need more help. Missing out generations. So given that we've got these still exempt accounts, obviously it might be quite nice to leave an account, pay the inheritance tax, but what you want to do is leave it to somebody who's not going to then immediately encash it, because then they're going to get that double whammy of tax without getting the benefit of further deferrals. So if you can leave it to somebody who's still got maybe 20 or 30 years before they might need the income, then that's going to, the extra return you get from the gross roll-up in the account is going to more than cover the cost of the inheritance tax. So it will still be quite a nice thing to do, but you're going to need to leave it not to your children, but your grandchildren, probably. And then also, again, we haven't done this, but we can see that it would be very tax efficient, might be even to skip 2 generations and leave it to minors, leave it to great-grandchildren, who could then encash it as like a school fees program or something like that. And because they're going to be minors without any income tax liability, they're not going to pay any income tax. So you're just paying the inheritance tax, one-off tax, and then they don't have any further tax to pay. So I think if you are going to keep money in your account, then make sure when you review your expression of wish that you think about carefully who those people are that you leave the money to.
I just said about the charities. Generally, when you leave charity, obviously it's exempt from inheritance tax, which is the same coming from your pension. But you're also allowed to do that 10% thing, where if you leave 10% of your estate to charity, you get the 36% rate of IHT. Now you'd have to direct that 10% of the charity, 10% of the pension, went to charity to get that 36% rate on the.
So how does that work?
So if you've got a free estate, if you direct that at least 10% of your free estate go to charity, you get a deduction for the charitable donation you make, but the remainder of the estate is then taxable at 36%.
Okay.
And you can pick and choose which parts of your estate you do that from. So if you have a free estate, you can do that, and you don't necessarily have to do it on your pension as well, but you'd only get your 36% rate on your estate then. Whereas if you did 10% of my free estate and my pension, you'd get the 36% rate across the board. Yeah.
How can a pension fund give to charity?
Well, I don't know, but they can.
Yeah, no, it's to set the expression of wish. It doesn't have to be a child, it could be Battersea Dogs Home.
Because it's a trust, isn't it? So you can pay it to whoever you want, really.
Yeah.
Laura, isn't there a circumstance where if you do that,
You get a better.
even though you've given the money to the charity, it still works out better net.
It's better, if you add up together what the
Yeah.
charity gets with the
I thought
payment
there
they
was one
receive.
where the charity gets, I've seen an example where the charity gets the money, but then because of the 36% rate,
Overall, you're
you
better
end
off.
up getting more money, so
Yeah,
it's
yeah.
win-win. Does
Yeah.
that ring any bells with you?
It does, I don't wanna go through it now.
I was just going to say on the expression of wishes.
Yes.
Is it possible to maybe great grandchildren that aren't born yet?
Yes.
It is.
Yeah, I mean, it literally is what it says. So it's the trustee's responsibility ultimately to pay out, but if they've got an expression of wish which says we'd like this to go to any grandchildren who are around, or then that's fine. Yeah.
You mentioned expression of wishes and maybe skipping a generation to great grandchildren. That facility is there anyway, because if you left it to children, they can vary because it's not definitive.
You could do a deed of variation on
Well, you
the.
don't need a deed. I don't think you need a deed, would you? It'd just be a question of agreeing with the beneficiaries to divert the money to someone else.
Agreeing with the pension scheme
Yeah,
administrators.
that's right. Yeah.
But it's only expression of wishes, isn't it?
Yes.
You've got ultimate discretion as to
Yeah.
who you pay to.
Yes. So if anybody, you wouldn't need it. You're quite right. So because you're not varying a will, you're just changing the trustee's mind.
So that's extremely flexible from that point of view, without any legality.
Correct.
But the
Yes.
pension scheme administrators always would like a
Yeah,
nomination to
that's
go
right.
off.
Of course, yeah. I mean, it's got to
Yeah.
be there in the first place,
Yes.
hasn't it?
So you write what you think you want to have happen, but if the family gets together and nobody's disadvantaged, the trustees can see that the people who were going to get the money are happy not to have it, then they're going to act on behalf of the family and do the right thing. Yeah. Yeah. Anything else on that? Life assurance. We had a little preamble of this with Andrew last night over supper, or over the first beer, I think. So, life assurance is you're going to find advisors pushing life assurance quite heavily for inheritance tax. I'm not sure about it, to be honest. I think it's a little bit questionable. So, I would definitely ask you to think about it hard before you sign up to any policies. I mean, the traditional thing that life assurance works well is where you're making pets potentially exempt transfers, and you've got this tapering 7-year liability to inheritance tax, which disappears. That's great, because then we can buy what's called a term assurance policy for covering those liabilities for the 7 years. We know what we're paying for with the insurance company, we know what the risk is, and you can just take a view on whether you like the premium or you don't like the premium. But that term assurance policy will never have any value. So it expires at the end of the 7 years, it's worthless. And if you tried to cash it in after 3 years, it would be worthless. So term assurances have no value along the way. They simply pay out if the event occurs, and if the event doesn't occur, they expire worthless. For inheritance tax, because you want it on death, you have to have what's called a whole of life policy. So something that is going to pay out eventually when you die. And because the IHT liability is on the second death, if you're in a couple, it's going to be a joint life second death policy. So it's not going to pay out on the first death, it's going to pay out on the second death. And a little bit of history, these were originally, I used to sell them a little bit in the 80s and 90s, and they would be with Scottish Widows and Standard Life, and we did everything with Scottish Widows and Standard Life in those days. And they would have been endowment policies, so with profit policies where every year they would add some bonuses to the account, and once they added the bonuses, they couldn't take them away. And they had surrender values. So as you got older, if you decided you didn't want to pay them, you could cash them in. And depending on how long you'd had it, they could offer quite nice returns, and some of the bonuses, and particularly as they all demutualised, you all remember we all got extra shares in Scottish Widows as they demutualised. Those changed. We then had a fashion of having flexible premiums or non-guaranteed premiums. So you would buy a whole of life policy, so you never had to be re-underwritten. But as you got older, the premiums would go up. So you'd get the premiums fixed for the first 10 years, then you'd have a review at 10 years, and up the premiums would go. But there was no re-underwriting. So if you got a disease or you were a lot worse, your health was a lot worse, it wasn't a problem, you were still insured for life, but the premiums would go up. And those weren't terribly popular because people started them, and then as the premiums went up, they became unaffordable towards the end of life. So now we've gone full circle, we've gone back to guaranteed premiums. So what's being quoted now when you ask a financial advisor will be a guaranteed premium for life. So you're not having to worry about the premiums going up. But we're back to this sort of version of an endowment type policy, in so much as the actuary's sitting there doing some maths and he's working out that, you know, roughly when he thinks the last person's going to die, and he's going to price the policy so that it's probably worth, in value terms, the sum assured at the end of that period. So you're saving into the account as well as paying for life cover in the early years. And these policies will have surrender values. And I checked it, Andrew, this morning. I did some Googling around and checked some of the policy terms and conditions, and they do indeed have surrender values. So this is the reverse of an annuity, really. So you get better value if you die young. With an annuity, you've got great value if you live forever. With a whole of life policy, you want both of you to die early to get the most out of the policy. If you live for a long time, they just become worse and worse and worse in terms of value for money. And I did some maths. This was an example of a couple that we were advising. Actually, Laura is doing some inheritance tax advice for them. And to cover for £1 million of cover, first, second death, whole of life, guaranteed premiums, 20,300 per annum. Now, on the face of it, it seems quite attractive, and what the life assurance salesman will tell you is the good news is that the million is outside of the estate, so there's no tax to pay on that. It's written into trust, so it never hits your estate, never attracts inheritance tax. And this 20,300 per annum is effectively depleting your estate, so you're not going to have to pay inheritance tax on that. So really, that's not costing you. It's not costing the next generation 20,300 a year. It's actually only costing them 60% of that, so £12,000 a year. So suddenly you're paying, in their minds, a net £12,000 a year for this £1 million payout. And even on the gross basis, even just taking the premiums, you say, okay, well, if one of us dies before 85, this IRR is a spreadsheet calculation that I can do, which tells me what return I'd need on that investment per annum to pay out £1 million. So forgetting the inheritance tax for a moment, just looking at 20,300 a year invested, if both people die, both partners die before 85, you're going to get a greater than 10% payout on the policy. So that's a pretty nice investment. But if you find yourself one of them living beyond 95, then the payout return is going to be less than 4%. And that's not such a good return now, given that the gilt rate is more than that, so we can make more than that risk-free. Does that make sense to everybody?
So does that include the inheritance tax then?
It doesn't, no, that's just a straight commercial, you're going to give me $1 million,
Right.
I'm going to give you 20,300. What rate of return are you giving me, depending on how many years it goes on for?
It's quite good psychologically though, because it's a hedge, isn't it? It's like, if you live, you only get a bad investment return if you live a very long life.
Correct.
People will be quite happy with that.
The people that tight with the money will be sitting there thinking I should die sooner than later.
They will.
Well, the other thing that we both came up with, because Andrew had heard the same pitch that I'd heard, is that what the salespeople are saying is the reason we can give you these great returns, these great rates, is that people don't keep them up. And that reminds me of, you know, we use that drain that goes between Waterloo and the city every day when we go into the office, and it's covered in advertising, and it's usually, because it's trying to attract people like Harry, it's usually brokerage accounts doing leverage puts and blah blah blahs. And when you read the small print across the bottom, it says 76% of people using this thing lose money, and you think that's a fantastic advert. And that's broadly the statistics. I think that more than 76% of people cash these in. And that, you think about it for a minute. Just think about how it was going to pan out. You start off, it's great. You're in your 60s. If we both die in an air crash tomorrow, which, you know, chances is that it's actually pretty zero. So the risk is not much, but you're all covered. So it sounds fantastic, you've got the cover. But as you get older, you're paying in this 20,300 and you're paying it, you're paying it, paying it. At some point around here, you're going to work out, well, actually, now the surrender value wouldn't be $1 million at that point. The surrender value is probably going to be 650,000. But I've got 650,000 with an insurance company, and I could be giving that to little Johnny or daughter this or daughter that, or paying for, you know, weddings or whatever. You know, that's a lot of money to have invested with an insurance company. You don't know how it's invested, you don't know what return you're getting on it. And that's when they get cashed in. So they get cashed in the early 80s. Because the premium's getting a bit annoying, because as we've just discussed, other expenses are coming down, and so this premium then starts to stand out as an expense. Probably don't notice it when you're skiing and everything else. But as you stop skiing and start sipping your food through a straw, sorry to be so, we've all got it to look forward to. This becomes a real annoyance, and you've got all this money with an insurance company, and the temptation to cash it in, I think, becomes pretty high. So people cash it in, so they're not getting these returns. They're ending up with something much less. Yes.
Does
Bob.
the surrender go into the trust if it's written into trust?
The surrender value won't be under trust, no.
Right.
No. Good point. It will come back into your estate.
Did you say there's tax relief on the 20,300?
There is no tax relief in practice, but if you think about it, the way the salesman will say, well, it's coming out of your estate, sir. So you're reducing your estate and you're saving the 40% on it. But you could do that anyway, right? By just investing that. If you give it to the kids and they invest it themselves, you're having the same tax efficient. So it's yeah. So I'm dubious, and I put this number down here as well because I was slightly shocked when I got the quote out that if we'd have arranged it, we would have been paid £12,000 for doing that, which is quite a nice burner if you're doing those on a regular basis. So beware would be my advice on that. And then this last one I think is mostly for Forbes Dawson, but
Yeah, do you want me to?
yeah, do you want to do it? Yeah.
Yeah, I mean, Andrew's had quite a bit of experience in doing this recently, and basically what it's about is leaving the UK, as a lot of people are, to encash your pension abroad. And it's not as simple as just going to any country and encashing your pension. I mean, Dubai is quite a nice one because it's tax-free when you take it out. You've got to go through some hoops to get the element out of the pension tax-free, such as telling the revenue not to take any tax out of it. But also you need to check the jurisdiction you're going to make sure that when you get there, it's the right tax system for you to take that out. I think Andrew's got a Maltese example that he can perhaps talk briefly about.
There's a guy in Malta. Well, we've had two experiences actually between us here. We've had Malta and the USA, and so the idea is, first of all, the default position is that a UK pension scheme is taxable in the UK. Most UK pension schemes are taxable in the UK because they're UK source, and so that's the starting point. You're going to have a PAYE reference, and tax is going to be withheld at the UK based on UK income tax rates. However, that's not always the case depending on tax treaties. Most tax treaties have a pension article which says something along the lines of, if you're resident in country X and the pension is based in the UK, the pension will only be taxable in country X, which in Dubai, for example, is as simple as it sounds, in that just says, it's a weird one because Dubai has no tax, so it says it will only be taxed in Dubai at zero. So if you fill out the right paperwork, you can be in Dubai and you can empty your pension scheme out tax-free. Other countries are a bit more complicated. So, for example, Malta says the same thing. So at first glance, you look at it and you go, well, that's great because get it out tax-free in the UK, but I don't need to have it taxed in Malta. The reason you don't need to have it taxed in Malta is because Malta has a remittance basis of taxation, a bit similar to the old non-dom regime here. So the plan, if you don't look at it fully, can be, let's not remit it, let's be resident in Malta, remit it to Jersey, say, and therefore pay no UK tax. However, there's another bit of the treaty later on, and this is why you've got to read all of the treaty, which says something along the lines of, if it's not remitted to Malta, the treaty doesn't apply. So the only way you get the relief actually is by remitting it to Malta, where it does get taxed. It gets taxed at a much smaller rate in the UK. It gets taxed at 15%. So it's still good there. And there's all sorts of variations on this. In the USA, it says it only gets taxed in the USA. However, only for things which are sort of regular pension payments rather than lump sums. It's a bit of an old definition, but they're also you basically just got to read the tax treaty. But if you go into the right place and with the correct planning, you can get it out all tax free. Other big caveat is you've got to be non-resident for 6 years usually to make that work. Otherwise, you get taxed when you return.
So yeah.
So in practice, and we've got two trying to do it at the moment. So the first thing to do is you have to make a withdrawal of a small amount in the UK, to get the PAYE reference number. I mean, we've got one person, well, both of them, because they've been outside of the country for a long time, haven't got any PAYE reference numbers. So you do £100 withdrawal out of the account through the pension provider. Then you've got to apply to get an NT tax code, which means they're not going to tax you. And then, as Andrew says, you've got to make sure, so that's basically persuading AJ Bell or Hargreaves Lansdown to not put it through the PAYE, but just pay it out in one check. And then you've got to make sure that you're not taxed, or you're taxed efficiently when you get it into the other jurisdiction. So we've got a gentleman trying to do it in the US who has got some big losses carrying forward from his oil and gas business. And he's trying to cash in a 650,000 account, but I suspect he thinks he can do it in one lump. And Andrew and I were talking last night that he might well have to have those withdrawals, regularised over a 5 or 10 year period.
It can still be part of your 25, what would have been your 25% tax-free lump sum.
He's added
But
25%.
it just has to be regular.
Yes.
For the US to
Yeah.
treat it as a payment, regular payment. Yeah.
If you don't do all that at the start, you can still end up having your pension paid out with UK tax deducted, and you can do a different but similar mechanism where you can get the
You can claim it back.
Yeah.
So there is a different
It's
route.
not all about getting the NT code, but
It's not as easy to get tax back though, is it, from the revenue? It's better if you can do the way around. It takes a long time.
It is better, but you still ultimately got to get under the treaty. You still ultimately have to have HMRC looking through it and saying, yeah, okay, you can have this without tax code.
Not surprisingly, it's not just a question of an email to AJ Bell to say, I live in Malta, can I have my pension paid out?
It takes about 5 or 6 months to get through the process.
If you take your pension out while you're non-resident then, but you come back within 6 years, that will still be caught by the...
Yeah, it's specifically one of the categories that if you come back, you're just assessed on it when you get back. You still get double tax relief for any overseas tax.
Which kind of does this, isn't it? I think that's the last one.
I think I'm the next
Oh no,
one,
you've got the last one.
Yeah. So what I thought I would talk about is some practical examples I've been doing recently. Obviously, as you're probably aware, I'm doing lots of business property relief planning for unquoted trading companies for, before 5th of April 2026, so the earlier changes, and that's sometimes throwing up some of these opportunities to involve the pension in the planning as well. So in this particular scenario, we had quite a lot of excess cash in the trading company that was surplus to requirements for the business. It's been accumulating over many, many years, and it causes a problem for business property relief in that it's going to not attract business property relief element. And we have a pension that has quite a large industrial unit in it that's been rented to the trading company, it's been using their trade throughout its history. Been quite a neat arrangement of getting rent, tax-free rent in the pension and deductions in Tradeco. However, these people are coming to retirement age and are looking at depleting the value of the pension and can't really do that with an illiquid asset in the pension. So they're wanting to sort of convert that property into cash to be able to withdraw from that pension scheme to reduce its value before 2027 and thereafter. And Tradeco is quite happy to use its excess cash to buy trading premises from the pension because it's helping its problem of the excess cash. So really we're swapping assets over. Fortunately, there's no capital gains tax for the pension on the sale of the property, but there will be stamp duty land tax, which is at 5%. So it seems like a small price to pay to get the assets in the right pots for what we want to achieve, withdrawing from the pension over time and also improving the position of Tradeco. Whether the 100% shareholder is going to continue holding the shares or whether he's going to give them away, business property relief is obviously very valuable, even with the restricted rates coming forward after 5th of April 2026.
I think that highlights a really important issue, which is liquidity. So, what we invest in is all liquid on a daily basis. So if you go and die, and we get the trustee saying we want to pay this fund out to this place and this IHT, that can all be arranged in 7 days. If you're in this situation and you own a commercial property in your pension fund, it's a nightmare, and it's going to cause all sorts of problems. So it's a big wake-up call to small self-administered schemes that are in property, SIPs that are in property. We've got one gentleman who's got an £8 million commercial property portfolio in his SIP. He's now trying to get out of it. Because it's just going to be really hard, it's not, the trustees don't really want to do it because it's going to be difficult or everyone in which way really.
One of my clients wanted to keep his because he was quite happy with the £400,000 of rent he's getting every year in it, which is a really nice return. And he was concerned about how he was going to pay the inheritance tax with the pension as well, and how he was going to do that. So I think some thought has to be into this. This is just a really neat solution for this particular client. And then it moves along to the fact of gifts, because business property relief, we're all talking about gifting these shares away now before 5th of April 2026, often into trust before the rules are restricted. So we can get whatever value we want into trust before that date, provided we have 100% business property relief. So a lot of our clients are considering giving quite substantial shareholdings away in trading companies. But what they don't really get their heads around is they can't really keep taking the same dividend they took before. If they give away, if they have 100% of shares and they end up with 50% and they still keep taking £1 million dividend out, which is what they've taken in the last 10 years, the revenue might have some problems with that, saying, well, actually, have you reserved a benefit in that 50% that you've given away? So again, we talked to them about, well, you can still take the same dividend if you want, as long as you're willing to pay the similar dividend to the shareholders you've given the shares to, such as a trust. But most of the time they don't want to do that. So we're having to think about other ways of getting income to them. And if they're giving away, in this example, the current position is they're not taking any pension income, has been always the case with those clients. And they've been taking £100,000 dividend on their shares. If they then give away 50% into a trust, then we recommend that they take less as a dividend, so there's no reservation of benefit issues. Technically, you could take 50,000. I've made it less here because I want them to take more out of the pension, because that is the asset that's going to get the double hit of inheritance tax and income tax dying after 75. So it's just really switching around the way they think about how they take their income. So we're sort of, every piece of planning we're doing now on BPR Trust is saying, well, why not just think about taking some income from the pension to top you up to where you were before? It's much more tax efficient to do it that way now. Obviously, dividends are a slightly different rate than a pension income would be, but it's infinitesimal really in terms of the rates of 32.5 and 40. It's not that much different. So you're going to reduce your IHT on your pension because you're reducing the value of the pension. If the pension is particularly big, you might not be with £80,000 a year, but you are slowly nibbling away at it anyway, hopefully, to make it better. I think that's it, I think, from us. I think, any questions from anybody?
Just a quick one on the number 5, where you said that the trading company had built up lots of cash. Mr. James would become an investment company. It's too much cash, isn't it?
Cash doesn't make it an investment. Well, no, cash itself doesn't make it an investment business because it's not an active management of investments. If they'd invested it in stocks and shares, then yes. If there was more than 50% of that activity and value, then yes. But cash itself will not cause a problem for whether the company's trading or not. So yes, that's the example, extreme example. We had a client with a business worth, I think it was 20 million. I think he had 11 million of cash in there. All he does is sit on cash and trades. He's still a trading business.
Interest on that money.
What's that, sorry?
Does he get interest?
He does, but it's not, the revenue don't see sitting on cash as an active investment business. They'll say it's passive, it's not an investment business, it's just cash. So it causes a problem for IHT in terms of that 11 million in my example would not get BPR, but it doesn't prejudice the whole company in its entirety. Now, if they were actively managing cash and moving funds around and going into different platforms, and which again, we've had another case, Sarah and I had a case of that, where he has been very active because of very good interest rate returns recently. So he's been moving it around and checking things out, and platforms and laddered cash things. That's more active investment, but just putting it into a number of accounts wouldn't be sitting on it. Okay. I've got your introduction to type in there.
Thank you.
It's all right. Anybody else got any further questions for either of us, really?